with these bank failures, the runs on the bank, people are having kind of a flight to safety. So there's a lot of money in banks that is uninsured because it's over the $250,000 credit limit. This is causing some people to seek out good rates in treasuries. So they're going to government money market type investments for cash rather than the prime fund, which is the banks and the financial institutions. So the problem with that is that banks have to have certain regulations. They have to have a certain amount of money on hand in case their depositors come calling for that money. And when they have a lot of uninsured deposits, that increases the level of concern for depositors, and they want to start to look elsewhere to get their money covered under the FDIC limits. So the problem with it sitting at the Fed and in government money markets is that takes it out of the lending markets. So banks have to have reserves and certain requirements to be able to lend money out. And you have also the Fed competing with banks in that the rates have been somewhat higher going to those types of investments. So what the result is credit tightening. And you say, okay, well, so what's the big deal with credit tightening? If banks are more conservative in their lending standards, that's a good thing, and usually it is. But the problem is that it means less money for businesses to expand. It means less money for construction. That's going to be a big problem in the private housing sector because we're already seeing a shortage of homes there. We've seen real estate prices during the pandemic go up 40%. That's quite a bit. And it started to cool off lately, but it's still not, I don't think we're going to see huge drops in prices. So credit tightening will impact construction and development, especially if small businesses see credit dry up. That's going to be a big problem. Small business is one of the biggest employers in our country, and we need them to stay strong or else we see jobs go away. And then this will trickle into employment, which happens to be the Fed's other mandate. Price stability is their first mandate. That's why they continue to raise rates so high, so fast, because they're trying to get inflation under control. That's price stability, preventing prices from going up or down too quickly or slowly. Their second mandate is full employment. So we've seen unemployment stay really low, but, as if this credit crisis continues to play out, I think we're going to start to see employment get affected.